Profit Planning, Chapter 10. This chapter focuses on the steps taken by businesses to achieve their planned levels of profits, a process called profit planning. Profit planning is accomplished by preparing numerous budgets, which when brought all together form an integrated business plan known as a master budget. So let's look at our first learning objective. Why organizations budget and the processes they use to create budgets. A budget is a detailed quantitative plan for acquiring and using financial and other resources over a specified forthcoming time period. The act of preparing a budget is called budgeting. The use of budgets to control an organization's activities is known as budgetary control. Planning involves developing objectives and preparing various budgets to achieve those objectives. Control involves the steps taken by management to increase the likelihood that the objectives set down at the planning stage are attained and that all parts of the organization are working toward the goal together. To be effective, a good budgeting system must provide both planning and control. Good planning without effective control is time wasted. Budgets communicate management's plans throughout the organization. Budgets force managers to think about and plan for the future. The budgeting process involves a means of allocating resources to those parts of the organization where they can be used most effectively. The budget process can uncover potential bottlenecks before they occur. Budgets coordinate the activities of the entire organization by integrating the plans of its various parts. Budgets define goals and objectives that can serve as benchmarks for evaluating subsequent performance. Our focus in this lecture will be on preparing operating budgets for a one-year time frame. However, longer-term budgets also can be very helpful to organizations from a planning standpoint. So the premise of responsibility accounting is that managers should be held responsible only for those items that they can control to a significant extent. Responsibility accounting systems enable organizations to react quickly to deviations from their plans and to learn from feedback obtained by comparing budgeted goals to actual results. The point is not to penalize individuals for missing targets. Operating budgets ordinarily cover a one-year period corresponding to a company's fiscal year. Many companies divide their annual budget into 4 quarters, and we focus on one-year operating budgets. A continuous or a perpetual budget is a 12-month budget that rolls forward 1 month or quarter as the current month or quarter is completed. This approach keeps managers focused on the future at least 1 year ahead. So, let's look at learning objective number 2. Understand basic budgeting terms and the behavioral aspects of budgeting. The initial flow of budget data in a bottom-up budgeting system is from the lower levels of management to higher levels of management. Each person with responsibility for cost or revenue will prepare his or her own budget estimates and then submit them to the next higher level of management. These estimates are reviewed and consolidated as they move upward in the organization. Therefore, it is also called a self-imposed budget or a participative budget that requires the full cooperation and participation of managers at all levels. It is a particularly useful approach if the budget will be used to evaluate managerial performance. Top-down budgeting is when top management sets all the key targets for the entire company. These key targets are then moved downwards for the middle and lower management to come up from other detailed budgeted figures. Under this approach, middle and lower management are tasked to complete the budget plan towards meeting the key targets set up by the top management. The key to self-imposed budgets is to get operational managers involved in the budgeting process and to clearly state their goals and expectations. Here is a list of 4 major advantages of self-imposed budgets. First, individuals at all levels of the organization are viewed as members of the team whose judgments are valued by top management. Second, budget estimates prepared by frontline managers who have intimate knowledge of day-to-day operations are often more accurate than estimates prepared by top managers. Third, innovation is generally higher when individuals participate in setting their own goals and when the goals are imposed from above. And fourth, a manager who is not able to meet a budget imposed from above can claim that it was unrealistic. Self-imposed budgets eliminate this excuse. So how to overcome problems of self-imposed budgets? Self-imposed budgets should be reviewed by higher levels of management. Without such a review, self-imposed budgets may have too much budgetary slack or may not be aligned with overall strategic objectives. Most companies do not rely exclusively upon self-imposed budgets, in the sense that top managers usually initiate the budget process by issuing broad guidelines in terms of overall target profits or sales. Lower level managers are directed to prepare budgets that meet those targets. Problems of self-imposed budget can be solved by the top-down budgeting approach. For example, it can avoid the potential budgetary slack, or what's called budget padding, provide a clearer performance goals and expectations from the top management, provide better budget due to top management's access to privileged confidential market and organization information, and fourth, provide an efficient budgetary process. Budget lapsing. A popular method among government agencies, universities, and organizations relying upon allocated funds. So any unused funding at the end of the financial period cannot be carried forward to the following year. As a result, the following year's budget may be cut because of the under expenditure in the previous year. There are advantages to budget lapsing. Budget lapsing helps ensure that the appropriate level of resource is utilized in each period. Without budget lapsing, risk-averse managers may unnecessarily accumulate funds just in case of any sudden fund requirements. Unnecessary savings from essential repair and maintenance, for example, may adversely affect the organization. It helps provide an opportunity for a clean cutoff of expenditures and to reallocate any unused resources for more appropriate requirements. The potential problem and solution for budget lapsing. Budget lapsing can cause undesirable behavior effects. The usual example is that managers may wastefully spend their entire budget before the end of the period in order to avoid budget cuts. A system of reviewing the expenditures near end of the period may uncover unnecessary expenditures and discourage managers to wastefully spend because of budget lapsing. Incremental method of budgeting is most commonly used by companies. Companies start off one year's budget by referring back to the previous year's figures. Adjustments are then made to the budget to account for the expected changes, such as prices for the next year. While incremental method of budgeting is practical and fast, Any inefficiency in the previous year's figures are simply carried forward. For example, if all along the organization is overstaffed, then the budget will continually be allowing for the overstaffing situation in this approach. Zero-based budgets are prepared based on the assumption that the company has just started. Therefore, the resources have to be justified from scratch. So, for example, when budgeting for staff cost for a restaurant, managers using the zero-based budgeting approach will ignore the existing staff level and expenses. Rather, they will examine factors such as opening hours, number of tables, expected patron numbers to work out the number of staff required at each position and level, hence the associated costs to produce a budget. Companies using the zero-based method do not simply ignore previous year's figures. Figures generated by the zero-based method are usually compared with previous year's figures. Any large differences are investigated. As zero-based budgeting is time-consuming and costly, companies tend to use this method for relatively large items and the incremental method for the rest. The success of a budget program depends upon three important factors. Top management must be enthusiastic and committed to the budget process, otherwise nobody will take it seriously. Top management must not use the budget to pressure employees or blame them when something goes wrong. This breeds hostility and mistrust rather than cooperative and coordinated efforts. Budget targets should be challenging but achievable in order to have good motivational effects. A budget committee is usually responsible for overall policy relating to the budget program, for coordinating the preparation of the budget, for resolving disputes related to the budget, and for approving the final budget. This committee may consist of the president and vice presidents in charge of various functions, such as sales, production, purchasing, and the controller. Learning objective number 3 is to understand the key components of master budget in the manufacturing, merchandising, and service industries. The master budget consists of a number of separate but interdependent budgets that formally lay out the company's sales, production, and financial goals. The master budget culminates in a cash budget, a budgeted income statement, and a budgeted balance sheet. So Exhibit 10-2 in the textbook provides an overview of the various parts of the master budget and how they are related. Companies in different industries adapt this master budget based on their particular needs. For a manufacturer, the first step in the budgeting process is the preparation of the sales budget, which is a detailed schedule showing the expected sales for the budget period. An accurate sales budget is the key to the entire budgeting process, as all other budgets, such as the production budget and the income statement budget, depend on the sales budget. The sales budget is compiled by taking into account, for example, past sales levels, general economic trends, competitors' actions, and pricing strategies. Once the sales budget is done, a manufacturer will do the production budget based on the sales budget and the required finished goods inventory. Finished goods inventory is necessary to cater for any unexpected change in demand. Thereafter, the production budget is utilized to determine the budgets for direct materials, direct labor, and manufacturing overheads. A budget for selling and administrative expenses will then be prepared. Finally, budgeted cash statement, income statement, and balance sheet are compiled. For a merchandiser, the first step is also the preparation of the sales budget. After the sales budget, a merchandiser will do a budget for the merchandise purchases. The sales budget and the inventory required to are utilized to compile the budget for merchandising purchases. Production, direct materials, direct labor, and manufacturing overhead budgets are not applicable for a merchandiser. Similar to a manufacturer, other budgets, including selling and administrative expenses, cash, income statement, and balance sheet, are prepared. For a service provider, same as a manufacturer or a merchandiser, a sales budget is done first. The sales budget gives details of the services to be provided and the related income. Based on the sales budget, other budgets are then prepared. To most service providers, human capital or human resources, budgeting, planning could be one of the most important budget after sales budget. A not-for-profit organization budget has many similarities with other organizations. The major difference is that this organization normally does not charge for its goods and services. Instead, funding is obtained from government bodies or donors. Therefore, there is no sales budget for a not-for-profit organization. Instead, it will have a budget for revenue or funding. From this budget, the organization will then plan for its activities accordingly by producing a budget for activities and expenses. Therefore, the first step of budgeting for every business is to budget for the revenue, whether it's a sales budget for providing goods or services or a funding budget. Although operational budgets are adapted according to the industries, they are very similar and typically comprise of budgets for income statement, cash, and balance sheet. We will next describe the detailed budget information for a manufacturer. Learning objective number 4 is to prepare a master budget for a manufacturing company. The master budget consists of a number of separate but interdependent budgets. We have developed the schematic of the budgeting process to illustrate the interdependency of the various individual budgets. The sales budget shows the expected sales for the budget period expressed in dollars and units. It is usually based on a company's sales forecast. All other parts of the master budget are dependent on the sales budget. The production budget is prepared after the sales budget. It lists the number of units that must be produced during each budget period to meet sales needs and to provide the desired ending inventory. The production budget, in turn, directly influences the direct materials, direct labor, and manufacturing overhead budgets, which in turn enable the preparation of the ending finished goods inventory budget. These budgets are then combined with data from the sales budget and the selling and administrative expense budget to determine the cash budget. The cash budget is a detailed plan showing how cash resources will be acquired and used over a specified time period. All of the operating budgets have an impact on the cash budget. And the last step of the process is to prepare a budgeted income statement and a budgeted balance sheet. So learning objective 4A. Let's prepare a sales budget including a schedule of expected cash collections. The marketing department of this company, called Royal Company, prepares the following information that will be used to prepare a budget for the quarter ending June 30th. Royal sells only one product, and that product has a selling price of $10 per unit. To calculate the total sales in dollars for any period, we multiply the budgeted sales in units times the unit selling price. So as you can see, Royal forecasts unit sales of $100,000 and total sales revenue of $1 million for the quarter ended June 30th. Once we complete the sales budget, we can move on to the expected cash collections from sales. All sales at Royal are made on account. the company collects 70% of the sales revenue in the month of sale, 25% in the following month, and estimates that 5% of all credit sales will prove uncollectible. At the start of the quarter, Royal had $30,000 in accounts receivable that were deemed to be fully collectible. So let's prepare the budget of expected cash collections on sales. The first step in calculating Royal's cash collections is to insert the beginning accounts receivable, $30,000, into the April column of the cash collection schedule. This balance will be collected in full in April. The second step is to calculate the credit sales in April that will be collected during each month of the quarter. We will collect another $140,000, which is $200,000 times 70%, in April. In addition, 25% of April projected sales will be collected in May. So $50,000 of April sales will be collected in May. Finally, 5% of April sales will prove to be uncollectible. This amounts to $10,000, which is $200,000 times 5%. The third step is to calculate the May credit sales that will be collected during each month of the quarter. We will collect $350,000, which is $500,000 times 70%, in the month of May, and an additional 25% of the $500,000 will be collected in June. Finally, 5% of May's sales will prove to be uncollectible. The uncollectible amount will be $25,000, which is $500,000 times 5%. So, can you complete the final month of June to get the total expected cash collections for the quarter? What will be the cash collections for the quarter ended June 30th? $905,000. There you go. The fourth step is to calculate the June credit sales, and that will be collected during the month of June. So we expect to collect $210,000, which is $300,000 times 70%, from June sales in the month of June. The fifth step is to calculate the total for each column in the schedule and the total for the quarter, $905,000. So now let's turn our attention to the production budget. After we have budgeted our sales and expected cash collection, we must make sure the production budget is adequate to meet the forecasted sales and to provide for the desired ending inventory. We need inventory on hand at the end of the period to minimize the likelihood of an inventory stockout. So the management at Royal wants to minimize the probability of a stockout of inventory items. A policy has been implemented that requires the company to maintain ending inventory of 20% of the following month's budgeted sales. At the beginning of the quarter, Royal had 4,000 units in inventory. If Royal was a merchandising company, it would prepare a merchandise purchases budget instead of a production budget. So let's get started on the production budget. The first step in preparing the production budget is to insert the budgeted sales in units from the sales department. The second step is to calculate the required production in units for April, which is 26,000 units. Notice the desired ending inventory in units for April, 10,000 units, and the beginning inventory in units for April, 4,000 units. What did you calculate as the required production for May? 46,000 units. How do we get that? This step is the third step, and it's to calculate the required production for May. And notice April's desired ending inventory of 10,000 units becomes May's beginning inventory. The fourth step is to calculate the required production for June, which is 29,000 units. Notice we are assuming a desired ending inventory of 5,000 units. This implies that projected sales in July are 25,000 units because 20% of 20,000 units is 5,000 units. The fifth step is to complete the quarter columns. Notice that April's beginning inventory and June's ending inventory are carried over to the column. For the quarter, we will need to produce 101,000 units to meet our sales and inventory goals. Now that we know our required production, let's look at the direct materials budget. Learning objective 4C. Prepare a direct materials budget including a schedule of expected cash disbursements or purchases for materials. Each good unit of output requires 5 pounds of direct material. Management does not want to run out of direct material, so a policy has been established that materials on hand at the end of each month must be equal to 10% of the following month's production. At the beginning of the month, Royal has 13,000 pounds of direct material on hand. Each pound of direct material costs 40 cents. So let's complete the direct materials budget. The first step in preparing the direct materials budget is to insert the required production in units from the production budget. The second step is to calculate the monthly and quarterly production needs, which in this case are stated in terms of pounds of direct material. The third step is to calculate the materials to be purchased for April, 140,000 pounds. April's desired inventory is equal to 10% of May's production needs, or 23,000 pounds. The total number of pounds needed in April is 153,000 pounds. Finally, we subtract our materials on hand to determine the number of pounds of material that must be purchased. During April, Royal must purchase 140,000 pounds of direct materials. So, how much materials should be purchased in May? 221,500 pounds. And that's how we get it. The fourth step is to calculate the materials to be purchased in May. Notice that April's desired inventory becomes May's beginning inventory. So May's desired ending inventory is 10% of June's production needs of 145,000 pounds. The fifth step is to calculate the materials to be purchased for June, which is 142,000 pounds. The desired ending inventory for May becomes the beginning inventory for June. We are assuming a desired inventory for June of 11,500 pounds. April's beginning inventory and June's ending inventory carry over to the quarter columns. Recall that Royal pays 40 cents per pound for direct materials. The company pays for 1/2 of its purchases in the month of the purchase and 1/2 in the following month. At the beginning of the quarter, Royal owed creditors $12,000 for purchases of direct materials. Let's begin the expected cash disbursement for direct materials schedule. The first step in calculating Royal's cash disbursements is to insert the beginning accounts payable balance, which is $12,000, into the April column of the cash disbursement schedule. This balance will be paid in full in April. The second step is to calculate the April credit purchases that will be paid during each month of the quarter. In April, $28,000, which is 50% of $56,000, will be paid in April, and $28,000 will be paid in May. The $56,000 is derived by multiplying 140,000 pounds by the 40 cents per pound purchase price. Now it is time for you to go to work. See if you can complete the expected cash disbursements for materials for the quarter. What'd you get? $185,000, and here's how you got it. The remaining step includes calculating the May and June credit purchases that are paid during each month of the quarter. We also calculate the totals for all columns in the schedule and the total for the quarter. Now let's move to the direct labor budget. Carefully review the information here. A unique aspect of the direct labor at Royal is the no overtime policy. The company agrees to no layoffs of employees if work is slow, but in return pays its employees straight time at $10 per hour for all hours worked. With the current workforce, Royal will have to pay for a minimum of 1,500 hours of direct labor regardless of the work available. The first step in preparing the direct labor budget is to insert the production in units for the production budget. The second step is to compute the direct labor hours required to meet the production needs. Remember, each unit of output requires 5 cents, half direct labor hour. We will require 1,300 direct labor hours in April, 2,300 direct labor hours in May, 1,450 direct labor hours in June. Because of the no layoff policy, Royal is committed to paying for a minimum of 1,500 hours per month. The third step in this example is to compute the direct labor hours paid each month and for the quarter. The number of hours paid will be the greater of the direct labor hours required, or 1,500 hours. In April, Royal will pay for 1,500 direct labor hours when there is only work for 1,300 hours. In May, Royal will pay for 2,300 direct labor hours, and the company will pay for 1,500 hours in June. So for the quarter, the company will pay for 5,300 direct labor hours. The fourth step is to compute the total direct labor cost. Based on the $10 per hour rate, Royal will pay $15,000 for direct labor in April, $23,000 in May, $15,000 in June, for a total of $53,000 for the quarter. So, what would be the total direct labor cost for the quarter if the company follows its no layoff policy but pays $15, which is time and a half, for every hour worked in excess of 1,500 hours in a month? Here's your answer. Now let's prepare a manufacturing overhead budget. Royal applies overhead on the basis of direct labor hours. The variable manufacturing overhead rate is $20 per direct labor hour. The fixed manufacturing overhead is $50,000 per month, of which $25,000 is non-cash costs, primarily depreciation on the factory assets. So this budget will provide a schedule of all costs of production other than direct materials and direct labor. The first step in preparing the manufacturing overhead budget is to calculate the variable manufacturing overhead costs for each month and in total. We begin by multiplying our variable manufacturing overhead rate of $20 times the number of direct labor hours used in the month. For April, we expect to apply $26,000 of variable overhead. The second step is to add the fixed manufacturing overhead costs, which are $50,000 per month, to the variable overhead costs to arrive at total manufacturing costs for each month and in total. We estimate total overhead of $76,000 in April, and for the quarter we expect a total of $251,000. If we divide the manufacturing overhead of $251,000 by the total labor hours required during the quarter, we get a predetermined overhead rate of $49.70 per hour. Once the level of fixed costs has been determined in the budget, the costs really are fixed. Hence, the time to adjust fixed costs is during the budgeting process. The third step is to calculate the cash disbursements for manufacturing overhead by subtracting non-cash expenses from the total manufacturing overhead costs. When we subtract the non-cash overhead costs from the total manufacturing overhead costs, we get the cash paid for overhead costs. We will use this cash overhead amount in our cash budget. In our example, $20,000 of depreciation is deducted from each month's total overhead costs to arrive at cash disbursements for manufacturing overhead. Royal can now complete the ending finished goods inventory budget. The first step in preparing this budget is to compute direct materials cost per unit. We know that each unit requires 5 pounds of direct material at 40 cents per pound for a total of $2 per unit. The information needed can be derived by referring back to the direct materials budget. The second step is to compute the direct labor cost per unit. It takes 0.05 hours to produce 1 unit, and the pay rate is $10 per hour. We have a direct labor cost per unit of 50 cents. The information needed can be derived by referring back to the direct labor budget. The third step is to compute the manufacturing overhead costs per unit. Royal uses absorption costing for valuing inventory. We apply overhead on the basis of direct labor hours, so we multiply 0.05 times the predetermined rate of $49.70, which yields an overhead cost per unit of $2.49. Our total unit cost then is $4.99. The predetermined overhead rate was calculated when we prepared the manufacturing overhead budget. Next, we will calculate the cost of our ending finished goods inventory. The fourth step is to calculate the value of the ending finished goods inventory. We will estimate there will be 5,000 units in the ending inventory, and that a per unit cost of $4.99. We have a total cost of $24,950. The finished goods inventory will appear on our budgeted balance sheet. The ending inventory in units is derived from the production budget. So our next learning objective is to prepare a selling and administrative expense budget. Royal has a variable and a fixed component to its selling and administrative expenses. The company estimates variable selling and administrative expenses at 50 cents per unit sold. Fixed selling and administrative expenses are estimated at $70,000 per month. Of this amount, $10,000 are non-cash expenses, primarily depreciation. The selling and administrative expense budget will be prepared in a manner similar to our overhead budget. This budget lists the budgeted expenses for areas other than manufacturing, and it is typically a compilation of many smaller individual budgets. The first step in preparing this budget is to multiply the variable selling and administrative rate by the number of units sold. In April, we expect to sell 20,000 units and apply the variable rate of 50 cents per unit. The second step is to add in the fixed S&A expenses to arrive at a total of S&A expenses. To our variable expenses, we add our $70,000 fixed selling and administrative expenses to get total selling and administrative expenses of $80,000. The third step is to deduct non-cash S&A expenses to arrive at cash disbursements for selling and administrative expenses. Cash selling and administrative expenses for April was $70,000. So what are the total cash disbursements for selling and administrative expenses for the quarter? $230,000. The same steps are followed for the months of May and June to arrive at total cash disbursements for S&A expenses for the quarter to be $230,000. Now, let's do a cash budget. The preparation of the cash budget can be very complex. This budget should be broken down into time periods that are as short as possible. It consists of 4 major sections. Cash receipts section lists all cash inflows excluding cash received from financing. Cash disbursement section consists of all cash payments excluding repayments of principal and interest. Cash excess or deficiency section determines if the company will need to borrow money or if it will be able to repay funds previously borrowed. And fourth, financing section details the borrowings and repayments projected to take place during the budget period. It would be a good idea to look at this information in detail, and we'll use it going forward here. The first step in preparing this cash budget is to calculate the total cash available. We began April with $40,000. To this amount, we added our expected cash collections from sales of $170,000 for the month of April. We complete the first section by calculating the total cash available of $210,000. Now let's continue with the budget preparation. The second step is to calculate the total cash disbursements. During April, we expect to pay $40,000 for raw materials, $115,000 for direct labor, $56,000 for cash manufacturing overhead, and $70,000 for selling and administrative expense. This is not the total manufacturing overhead because we have excluded non-cash depreciation costs. During April, the Board of Directors paid a cash dividend of $49,000. We now have completed the second major section of the cash budget, cash disbursements. The third step is to calculate the excess or the deficiency of cash available over disbursements. In the month of April, we expect to have a cash deficiency of $20,000, given that Royal has a policy that the company will always maintain an ending cash balance of $30,000. The fourth step is to determine the financing requirements and the ending cash balance. After Royal borrows $50,000 on its line of credit, it will have an ending cash balance of $30,000. The ending cash balance for April becomes the beginning cash balance for May. So let's complete the cash budget for the month of May. These four steps are repeated for the month of May. The result is a $30,000 excess of cash available over disbursements. Since Royal must maintain a minimum cash balance of $30,000, it will not repay any of its loan in May. So what is the excess or deficiency of cash available over disbursements for June? $95,000. Here's where the solution is. The same four steps are repeated for June. The result is an excess of cash available of $95,000. At the end of June, Royal will have sufficient cash to repay $50,000 borrowed in April, plus the interest on the loan. The total interest is $2,000 as demonstrated in the computation of interest box on the left side of the screen. Royal will end the quarter with $43,000 cash on hand. This cash balance will appear on our budgeted balance sheet. We are now ready to move from the preparation of individual budgets to preparing our budgeted financial statements. The cash budget must be prepared first so that the interest expense can be determined for the budgeted income statement. So let's start with the income statement. The numbers for the budgeted income statement come from the other budgets that have been already prepared. More specifically, the sales revenue comes from the sales budget. The cost of goods sold on a per unit basis comes from the ending finished goods in the inventory budget. The selling and administrative expenses comes from the S&A budget. The interest expense comes from the cash budget. Royal calculates budgeted net income for the quarter at $239,000. With the income statement complete, we can now move on to the budgeted balance sheet. Here's the information. You can see our cash balance of $43,000 comes directly from the cash budget. Accounts receivable, $75,000 is 25% of June sales, which were $300,000. Raw materials inventory of $4,600 is calculated by multiplying the ending inventory of raw materials in pounds by cost per pound. The finished goods inventory is $24,950. It's taken from the ending finished goods inventory. The land and equipment amounts are given. Accounts payable is 50% of June's purchases, and the balance in the common stock account is given. The balance of retained earnings at June 30 is $336,150, which is based on the beginning balance plus net income minus dividend paid. So let's prepare a budget on the key components in the service industry. So this section illustrates the essential aspects of budgeting on say a theme park like Disney. We'll call it Wonder World is a theme park which has some mechanical rides, an aquarium, and a dolphin pool. On average, about 1 million visitors, including locals and tourists, are attracted to the theme park annually. Wonder World is a very profitable company. Wonder World has three main sources of revenue: ticketing, food and beverages, and the souvenir shop. For expenses, the major ones are salaries, rent, and cost of sales for selling food and beverages and souvenir items. Wonder World has a number of departments: finance and admin, operations, marketing, souvenir shop, food and beverage, and maintenance. Each of the department head provides input of his or her area of responsibility for the company's annual budget. So now let's prepare a visitorship budget. Based on historical records, the economic outlook, tourist arrival expectations, the visitorship budget is then prepared. This is the important step of the budgeting process for a theme park, since the revenue and expenses are driven by these numbers. So in this case, we have adults and children that are going to be 750,000, 250,000, totaling 1 million people. So what's our revenue budget? Based on the average price charged by Wonder World and other historical data, the revenues budget, including gate collection, which is the entrance ticket, souvenir shop revenue, and food and beverages revenue per visitor, are prepared and approved by top management. With the budgeted number of visitors and revenues per visitor from each category, the budgeted revenues are computed. So we have 22 million is budgeted revenue. Now let's do a cost of sales budget. For cost of sales on souvenirs and food and beverage, the company normally makes use of the historical cost of sales percentage and takes into account of any expected price changes from the suppliers. So for the coming year, the expected cost of sales percentage is budgeted at 50% on sales for both the souvenir shop and food and beverages. Now we got the expense budget. Regarding rental expense, Wonder World has an agreement with its landlord to pay a lump sum of $200,000 or 5% of revenue, whichever is higher. Since opening of the attraction, Wonder World's 5% of revenue has always exceeded the $200,000 lump sum by a very far amount. Therefore, its budgeted rent can simply be computed at 5% of sales. Salary expense is a top expense item for Wonder World. Each year, the head of finance will analyze and discuss salary expense with top management and recommend the appropriate amount to be budgeted for the next year. Generally, for salaries, the zero-based budget approach is used to estimate the budget figure. For incremental approach, we take last year's expense and adjust for changes in headcounts and rate of pay. For the zero-based approach, we do not start off with last year's figure. Instead, we review from scratch the number of staff required based on tasks and duties to be performed. Suitable rates of pay for different levels of staff are discussed. With this method, any inappropriate staff number or pay will not be carried forward into the next year. Advertising is more of a discretionary item for Wonder World. The marketing manager will propose the amount to be spent and estimate the effect of the advertising before seeking the approval of the top management. For TV advertising, viewership, demography, together with detailed costing, will have to be presented to the top management for approval. In the end, the top management will decide on the types of advertisement and the total to be spent. Maintenance expenditure is more of a technical area and safety cannot be compromised. The maintenance manager has a bigger role to play in terms of the amount required. The maintenance manager will list down the various maintenance enhancement jobs required to be done next year and estimate the total budget required for these jobs. Top management will go through the list and discuss with the maintenance manager to decide on the timing of the jobs. For maintenance jobs, they normally get approved, and for the enhancements jobs, top management may decide to delay the jobs for a while. Depreciation expense is mainly computed by the finance department. The expense can be computed by using all the existing depreciable assets values and depreciation policies plus any applicable additional depreciation for assets to be acquired in the coming year. If all planned purchases are according to the original plan, depreciation expense budget can be fairly accurate. The maintenance department is also responsible for estimating the amount to be budgeted for utilities. Current facilities, planned new facilities, change in rates of utilities will be taken into account to estimate the utilities expense for next year. It should be noted that Wonder World utilities are not so sensitive to change in the number of visitors. Even with a very low level of visitors, air conditioning and lightnings for all the indoor facilities have to be kept on. The life support system, which consumes a lot of electricity, has to be kept on for fishes and dolphins. Other operating expenses such as legal and audit fees, travel, and fish food are estimated based on a combination of historical information and human judgment. In general, the smaller items require less time to estimate based on the cost and benefit rule. So, now we can prepare an income statement. Here we go. Putting all the information together. Now we have to explain the costs and benefits of budgeting. Budgeting is time-consuming and costly. Budgetary slack or padding is an inherent problem of budgeting. Despite the drawbacks of budgeting, most companies are still using budgets to plan, communicate, set objectives, and allocate resources. Since budgets are still commonly used, benefits of budgeting must be high, and drawbacks of budgeting can be minimized by having a good budgeting system. For a good budgeting system, it is critical to have effective communication and a mutual trust between the top management and its staff.